$20.6 million. That's how much retail traders net sold in single stocks on Monday. The catch: the market was up. The Dow surged 600 points on hopes of a U.S.-Iran ceasefire. And for the first time since November 2023, the investors who've been the market's most reliable dip buyers decided they'd rather sell into the rally than ride it. The day Wall Street cheered. Wednesday's session carried forward the cautious optimism that started this week. The Dow climbed over 300 points to 46,429. The S&P 500 rose 0.54% to 6,591, and the Nasdaq added 0.77%. Brent crude pulled back to around $96 after briefly touching 100 earlier in the week. The 10-year Treasury yield dipped to 4.33%. VIX fell to 25.86. On the surface, a textbook relief rally. The trigger was familiar. Trump told reporters that talks with Iran were productive. A 15-point peace plan surfaced, delivered through Pakistan. Coffee prices slipped on hopes the Strait of Hormuz could soon reopen. JP Morgan and Citi both raised Amazon price targets, citing surging AWS demand. ARM Holdings soared after announcing plans to sell its own AI server chips. Microsoft and NVDA unveiled a joint nuclear energy AI platform. The mood was unmistakably bullish. But underneath all of it, something was off. The very people who fueled every rally since late 2023 weren't buying. Why retail sold into the green? Vanda Research flagged it first. On Monday, retail traders were net sellers of single stocks by $20.6 million. That might sound small against the market's trillions, but the direction matters more than the size. This cohort hasn't been net sellers since November 2023. They bought through the AI sell-off. They bought through tariff panic. They bought through the first week of Iranian missile strikes. Then, on a green day, they sold. The clearest signal isn't just that retail investors net sold, said Adam Woodhead of the Investor Center. It's that this happened on a rebound day rather than during a sharp sell-off. That tells you this isn't panic, it's repositioning. The distinction matters. Panic selling looks like capitulation. Repositioning looks like a calculated withdrawal. According to Vanda, the trend since early March has been one of gradually receding retail participation, alongside systematic deleveraging. Retail has since returned to modest dip buying, but the pattern has shifted. Finame CEO Carl Hazley noted that individual investors aren't leaving the market entirely. They're rotating from single stocks into ETFs, swapping stock-specific risk for broader exposure.
This is exactly what happened in late 2018, when retail investors began trimming single stock positions months before the broader market corrected. It wasn't a crash signal. It was a confidence signal. The willingness to take concentrated bets was fading. Here's the problem. The macro backdrop today is worse than 2018. Moody's Mark Zandi put recession odds at nearly 50%. The economy unexpectedly lost 92,000 jobs in February. Oil has averaged above $95 for 3 straight weeks. Iran has rejected the U.S. ceasefire proposal. The Strait of Hormuz is effectively closed, with only 2 vessels crossing on March 24 versus the usual 150. Fertilizer prices are spiking, and the IEA says the current energy disruption is larger than the 1973 and 1979 oil crises combined. In that context, retail selling into a rally isn't irrational. It might be the most rational thing happening in this market. The signal no one wants to see. There's a historical rhyme worth noting. In November 2023, the last time retail went net negative, the S&P 500 was mid-correction, down about 10% from its July high. Retail selling marked the bottom. Within 2 months, the index had reclaimed its highs and began the AI-driven run to 6,000. The optimistic read, retail capitulation is a contrarian buy signal, just like last time. The problem with that read is the conditions are inverted. In late 2023, the Fed was about to pivot dovish. Inflation was falling, and earnings were accelerating. Today, the Fed is stuck. Inflation expectations are rising on energy costs. Earnings are under pressure from fuel surcharges. Amazon itself warned that rising oil could shave $1.5 billion from its 2026 operating income. And unlike 2023, the geopolitical risk isn't theoretical. There are 45,000 dead and a major shipping lane is shut. If Iran and the U.S. reach a deal by week's end, as Trump insists they will, oil could drop $15 overnight and the entire repositioning trade reverses. Retail flows snap back, shorts get squeezed, and the market rips higher. But Iran's response on Wednesday was blunt. Tehran rejected the 15-point plan. It demanded reparations, base closures, and permanent toll rights over the Strait of Hormuz. The IRGC wants to charge ships $2 million per transit, payable in yuan. The gap between the two sides isn't narrowing, it's widening. The market is pricing in a deal. Retail is pricing in the possibility there won't be one. One of them is wrong. Brent crude at $100 is the line. If it holds above that level through Friday, the optimists have a problem no peace talk headline can solve.